Welcome to the Deep Dive, where we cut through the noise to bring you the insights that truly matter. Today, we're diving into a remarkable success story in the retail world, one that's actually bucking some of the broader market uncertainties we've all been hearing about. We're talking about Burlington Stores, Inc.
That's right, the off-price retail giant.
Right.
They just delivered exceptionally strong second quarter results for fiscal 2025.
Really strong.
Yeah. So for this deep dive, we've meticulously analyzed Burlington's recent earnings call transcript and, dug through their detailed SEC filings. Our goal is to bring you the clearest picture of what's really driving their performance.
And our mission today is clear. We're going to unpack the key factors behind their standout quarter, explore their strategic Burlington 2.0 initiatives, which sound like they're really paying off,
Definitely.
and understand how they're skillfully navigating a very dynamic retail landscape. Ultimately, we want to figure out what all of this means for you, the consumer, and for the entire retail sector.
It's a fascinating case study, really. Adaptability, strategic growth.
Yeah, absolutely. Let's get into it. All right, let's start by looking at the numbers from Q2 2025, because they are truly impressive. Burlington reported total sales that soared by 10%. Get this, that's on top of a robust 13% growth from the previous year.
Wow, that's stacking growth.
Right. And their comparable store sales, sales from stores open for at least 15 months, gives us that apples-to-apples view. Also increased a solid 5%, building on another 5% increase last year.
Again, stacking it.
Exactly. And the company also announced an adjusted EPS of $1.72. That's their earnings per share, a key profitability metric.
And that number significantly beat their own guidance.
Which, in today's economic climate, is a huge win.
A critical takeaway here, I think, is that these consistent double-digit growth rates aren't just luck. They powerfully demonstrate the inherent strength of Burlington's off-price business model. They're consistently gaining market share, even when the broader retail environment feels, uncertain. This was a really high-quality earnings beat. Driven by healthier merchandise margins, basically. They're making more profit on the goods they sell.
Okay.
And significant efficiencies right across their entire P&L, from buying to store operations.
So across the board.
Yeah. And while sales started a little slow in May, maybe due to that cooler weather in the Midwest and Northeast affecting spring clothes.
Right, that makes sense.
They really picked up momentum in June and July as temperatures normalized. This rapid acceleration highlights their agile ability to react.
To react to immediate conditions.
Exactly. Shows they can quickly capitalize when consumer demand shifts.
So the numbers are undeniably strong. But what's the real story behind this success? What's the engine, driving this performance?
Well, Burlington's leadership points squarely to their Burlington 2.0 initiatives.
Right. I wanted to ask about that.
Yeah, it's the strategic overhaul they've been working on for a few years now, and it seems like they are truly hitting their stride, starting to show their full potential.
Okay, so let's break that down. There are three core areas, right? Merchandising 2.0, stores 2.0, and the impact of new stores.
That's it. Those seem to be making the biggest impact.
Okay, let's kick things off with Merchandising 2.0. This isn't just a fancy name, is it?
No, not at all. It's actually a suite of new systems, processes, tools, all designed to empower their buyers and planners to react with incredible speed to market changes.
And they got a real-world stress test this quarter, didn't they, with those unexpected tariff announcements back in early April?
Oh, absolutely. And what's truly insightful here is how Merchandising 2.0 enabled Burlington to not just weather, but skillfully navigate that major economic surprise. In the weeks leading up to the tariffs, you saw their teams making multiple rapid revisions to their assortment plans. For Q2, for the fall season.
So real-time adjustments.
Exactly. They expertly pivoted away from categories with high tariff exposure. Think decorative bedding, cookware, maybe some toys. Areas where finding alternative suppliers outside China is tough.
And where tariffs could really bite into profit.
Precisely. Instead, they strategically shifted towards products with less tariff impact, more reliable, diversified supply chains.
Smart.
And this involved not just changing what they bought, but also complex remixing and remodeling of their margin plans, actively working to offset those tariff pressures.
So it wasn't just reactive buying, it was financial planning too.
Absolutely. And despite this significant headwind, which actually impacted inventory levels across the whole industry, Burlington still achieved that remarkable 5% comp growth.
Wow.
Merchandising 2.0 provided the crucial visibility and the agile tools necessary for that rapid, effective, and, importantly, profit-preserving response.
It's a testament to planning for unpredictability.
Couldn't agree more.
That's a fantastic example of agility. Now let's talk about Stores 2.0. Historically, Burlington's image, well, they even said it themselves, might have been big old difficult-to-shop stores.
Yeah, that coat factory heritage.
Right. But Stores 2.0 is fundamentally changing that perception for customers.
And this raises an important question, How does an established, often beloved brand successfully revitalize its physical presence? Enhance the customer experience without losing its identity?
Good question.
Burlington has been working incredibly hard to uplift the entire shopping environment. They've set higher standards for store managers, for teams, focusing on the customer journey from the moment you walk in.
And it's working.
Seems like it. These programs have really taken off in the past year. Customer service scores hitting historical highs, improvements across all major operational metrics.
That's significant.
And what's more, store teams have genuinely embraced these changes, which has led to a sharp rise in associate engagement.
So it's better for shoppers and employees.
Exactly. And physically, about half the entire chain has been retrofitted, reimagined store layout, updated signage, new fixturing.
Trying to make it feel.
Well, their words were new and more exciting, easier to shop, more fun, more off-price, and more Burlington 2.0.
Making that treasure hunt easier, maybe.
I think that's the idea. And this comprehensive redesign contributed a nice sales lift directly to their Q2 comp growth.
So it proves investing in the physical space really does pay off.
It really does.
So Stores 2.0 is enhancing the existing locations, but it's not just about refining the current footprint. Burlington is also aggressively expanding. 23 net new stores in Q2.
Yeah, and ambitious plans for 100 net new stores in fiscal 2025.
That's a lot of growth.
It is.
Yeah.
And what's truly insightful here is the long-term strategic impact of these recently opened stores. Once they hit that 15-month mark, they enter the comp base.
Right.
And what Burlington is finding is that these younger stores don't just perform okay, they ramp up over time and actually come well ahead of original expectations for their first few years.
So they outperform initially.
Significantly. So as the mix of these newer, higher-performing stores and their comparable base continues to grow over the next few years, Burlington anticipates this will create a significant comp tailwind.
A comp tailwind, like an accelerating force.
Exactly. Pushing up overall comparable store sales, becoming a foundational driver for sustained growth well into the future. It's smart strategic expansion.
Okay, so given such strong Q2 performance and these powerful initiatives kicking in, you might expect them to be, aggressively optimistic.
You might think so.
But Burlington is maintaining a cautious outlook for the back half. Comp sales guidance of just 0% to 2% for Q3 and Q4. Why the conservative approach after such a great quarter?
Yeah, it does seem a bit conservative on the surface, but it raises an important point about balancing past success with future uncertainties, especially in retail. Burlington has that strong heritage in outerwear, right?
The coat factory roots again.
Which makes them particularly sensitive to seasonal weather variations, especially in Q3. An unseasonably warm or cool fall can really impact sales for key categories.
Okay, weather risk. What else?
Well, there are broader macroeconomic risks looming. We're talking potential higher unemployment, persistent inflation impacting spending power, general shifts in consumer confidence.
Usual suspects.
Right. And those tariffs we discussed, they are actually higher now than they were back in May. That presents an unpredictable challenge, not just for them, but for the broader economy.
So caution seems warranted then.
It does. But the good news for Burlington, though, is that as an off-price retailer, their business model doesn't really require them to predict the future perfectly.
How so?
Their playbook is inherently designed to be nimble and flexible. It allows them to react quickly no matter what twists and turns the market takes.
That standard playbook sounds intriguing for navigating this uncertainty. How exactly do they plan to execute it in the coming months?
Well, they are managing cautiously, but with clear intentions. They've got terrific outerwear buys and reserve inventory.
Meaning they've already bought the winter coats.
Essentially, yes. Secured great deals probably before the latest tariff hikes, and they're ready to deploy it. This positions them perfectly to chase a stronger trend.
The chase.
Right. To quickly capitalize and flow in more merchandise if consumer demand unexpectedly strengthens, they won't be caught flat-footed.
And how are they handling the tariff pressure specifically?
It's multi-pronged. Continually negotiating with vendors on costs, adjusting and remixing assortments to favor less impacted goods.
Okay.
Selectively raising retail prices where absolutely necessary and strategically possible, driving faster inventory turns to cut down on markdowns.
Because faster selling means less discounting.
Exactly. And aggressively pursuing expense savings across the entire organization. Their Q2 performance already showed they can rapidly flex up and chase a stronger trend, so they're just applying a proven strategy.
Makes sense.
Yeah.
Let's shift to some more specific financial details because that operational discipline really shows up in the numbers. Their gross margin rate in Q2 was 43.7%. That's up 90 basis points, nearly a full percentage point over last year.
That's a healthy jump.
And their adjusted EBIT margin earnings before interest and taxes, a good indicator of core operational profit, expanded even more by 120 basis points.
Wow.
How did they pull that off in this environment?
Well, this kind of margin expansion doesn't just happen by accident. It's incredibly disciplined financial management. The 90 basis point increase in gross margin was driven mainly by two things: a 60 basis point increase in merchandise margin
Okay.
and a 30 basis point decrease in freight expense. Shipping costs came down a bit.
Got it. And the merchandise margin?
That came from improvements in shortage, meaning less shrink, less lost inventory, and lower markdowns. Those two things more than compensated for maybe a slightly lower initial markup they had to take because of tariffs.
So less theft or damage, less discounting, more profit per item.
Basically, yes. And product sourcing costs stayed flat as a percentage of sales, so they're holding the line there. And maybe most impressively, adjusted SG&A costs, selling, general, admin expenses.
Overhead.
Right. Those actually decreased by 30 basis points, thanks to targeted savings initiatives and just leveraging those higher comp sales.
Right, spreading fixed costs over more sales.
Exactly. It's a very disciplined approach to cost management, top to bottom.
That's a great breakdown of the profit levers. And speaking of inventory, we heard that comparable store inventories were down 8% at quarter end. Sounds good for turns.
Right, leaner in the stores.
But then the reserve inventory was up a huge 43%, now making up half their total inventory. Why this kind of dual strategy? It seems almost contradictory.
It does on the surface, but it's classic Burlington strategic agility. It's actually quite fascinating. The lower in-store inventory is deliberate, drives faster turns, merchandise moves quicker, and critically reduces the need for markdowns. Vital for offsetting those tariff pressures, keeps things fresh.
Okay, lean in the store makes sense, but the huge reserve.
Equally strategic. That reserve, now half their total stock, is largely made up of great deals they bought at pre-tariff pricing. They essentially locked in lower costs before tariffs potentially drove prices up.
So it's like a strategic buffer.
A massive buffer, exactly. It provides immense flexibility, allows them to rapidly flow in desirable merchandise if the sales trend unexpectedly picks up. It perfectly reinforces that chase strategy we talked about, ensures they don't miss an opportunity to sell at full value.
So lean in the stores, but powerful buying power ready in the wings.
You got it. That's the essence of it.
And on the balance sheet, they also made some significant moves, investing in the future, shoring things up.
Absolutely. They strategically raised $500 million in additional term loan debt, primarily to fund the purchase of a highly automated West Coast distribution center.
A big infrastructure investment.
Crucial investment in their future supply chain efficiency and growth. They also upsized and extended their ABL facility, that asset-backed lending facility, like a credit line,
Great.
to $1 billion, maturing way out in July 2030. These moves left them ending the quarter with really robust liquidity, about $1.7 billion, including a substantial $748 million in cash.
Strong position.
Very strong. Plus, they repurchased $26 million in common stock and still have over $600 million left on their authorization.
So investing in the business and returning value to shareholders.
Both. A balanced approach.
Okay, beyond the financials, you're probably wondering how different customer groups are performing in this environment. Q2 comp sales were described as broad-based.
Right, meaning across the board.
But were there any specific demographic trends that really stood out in their data, maybe telling us something about the current consumer?
Yeah, this is a really insightful area because it tells us who Burlington is resonating with right now. Stores located in lower-income trade areas actually continued to perform very well. Comp sales growth just above the chain average.
Interesting. So
Yeah.
Even with tight budgets, the value proposition is working.
Seems so. The off-price model is drawing those customers in. And for Hispanic customers, after adjusting for some specific situations, like really strong performance in Puerto Rico and slightly weaker performance at southern border stores, which they linked to border issues, not core demand. The remaining high Hispanic trade areas also showed trends slightly above the chain average.
So also performing well overall.
Yes. And this data is incredibly encouraging for them, I think. It strongly suggests these important price-sensitive customer groups aren't currently facing, significant economic issues that would stop them from shopping at Burlington.
Their focus on value, quality, brands. It's clearly connecting.
There really seems to be.
It sounds like they're truly connecting with their core value-conscious customer effectively. What about specific seasonal trends like back to school? How did that perform given the economic backdrop?
Yeah, good question. Their back-to-school business has been very pleasing, they said. Performed well with strong early selling in July and then solid sales in August.
So a successful season.
Looks like it.
Good.
And over the last few years, Burlington has pursued a very deliberate, focused strategy to increase their market share in back to school. They understand their core customers, often have larger families, are highly value-focused, making this a critical season for them.
Makes sense.
So by offering strong fashion, recognizable brands, terrific quality, and unbeatable prices, they've successfully met the needs of those parents and students and gained significant market share in this crucial seasonal period.
It's about understanding their customer deeply and just delivering precisely what they need.
Exactly. Textbook execution, really.
What a phenomenal deep dive into Burlington Stores. We've seen how they deliver truly exceptional Q2 results, propelled by those strategic Burlington 2.0 initiatives, agile merchandising, better store experience, smart new store growth.
A winning combination.
Yeah, and they're approaching the back half of the year with this cautious but remarkably flexible strategy, ready to chase sales trends while actively mitigating risks like tariffs.
Prepared for anything.
Their consistent, strong performance with key customer demographics. It just highlights a profound understanding of their market and their customers' needs.
Indeed. And the beauty of these Burlington 2.0 initiatives, especially Merchandising 2.0 and Stores 2.0, is that they're still, relatively early in their rollout.
Still more runway there.
Exactly. The company clearly anticipates this positive momentum will not only continue but actually grow, deliver even greater results and market share gains over time. They've built a really robust foundation for the future.
So here's a provocative thought for you to consider as we wrap up. Burlington's off-price playbook demonstrates remarkable resilience and agility in navigating challenges like tariffs and inflation. As traditional retailers grapple with rapidly changing consumer demands and economic pressures, how much of Burlington's nimble, responsive approach to inventory, pricing, even the store experience, can or maybe should be adopted by the broader retail industry to future-proof their own operations?
That's a great question to ponder. How much of that off-price DNA can translate? Fascinating stuff.